Hello everyone, thanks for checking out my video. We just had the biggest bank failure since the 2008 global financial crisis, sending shockwaves through the banking sector. The collapse of Silicon Valley Bank fueled a broad market sell-off. All three major average indices ended the week with losses, falling by more than 4%. To add on to that, Jerome Powell shared that he favors a faster interest rate hike, which is bad news for the market. CPI number is set to be released this week. Are we going to expect more pain ahead? Watch on to find out more. Wall Street digested several major events last week, which was an eventful week. These events can largely be summarized into three key topics: Jerome Powell, jobs reports, and the collapse of Silicon Valley Bank. First up, Jerome Powell, who spoke before the Senate Banking Committee, then the day after to the House Financial Services Committee. The crux of his words is that the ultimate level of interest rates are likely to be higher than previously anticipated because the latest economic data have come in stronger than expected. As for the upcoming interest rate hike, Powell told lawmakers that the Fed would keep its options open for how much higher to hike the interest rates, leaving investors and traders guessing will it be a 25 or 50 basis point hike. Powell also said that he will be watching the upcoming economic data closely, such as last Friday's non-farm payrolls report, upcoming consumer and producer price indexes. Next, it's the February non-farm payroll report, which is a mixed result in my opinion. Firstly, the bad news for the stock market is that the number blew past expectations once again, as 311,000 jobs were added, where the consensus estimate was only 225,000. However, this number is still lower than the previous month of 517,000, which can be seen as a good news to the market. To add on, the unemployment rate went up slightly to 3.6% from previous month of 3.4%. Finally, the wage growth rose 4.6% on a yearly basis, which is slower than expected. These are in a way good news for the stock market because lesser employed citizens, coupled with smaller salary growth, may potentially help to bring down inflation. Okay, lastly, let's talk about the developing saga of Silicon Valley Bank, which shook the financial world last week. Long story short, SVB surprised investors with news that it needed to raise $2.25 billion to shore up its balance sheet and had to sell its assets at a loss. And then things escalated quickly. And by the time the world starts to digest what's happening, US regulators have already shut down the bank and its stock was halted for trading. Specifically, the bank's share price tanked 68% during Friday's pre-market trading session before being halted. These events raised fears among other banks and sent many bank stocks tumbling across the industry, pushing S&P 500 Financials index sector down 4% by the closing hour, marking its worst drop since June 2020. All in all, towards the end of the week, US bank stocks lost more than $100 billion in the market cap in the space of 24 hours. Investors are now taking a step back to observe whether SVB's problems would cause contagion, and because of this, they bought bond, which then caused the 2-year yield fell massively in just 2 days, the biggest of such moves since the financial crisis. And as shared in the previous video, when bond yields fall, it's good for the market. But then again, you must be thinking, there are some good news and many bad news, so what's next for the stock market? Well, there are a couple of things to look out for this week, and the next 2 weeks in fact. But for now, the focus will fall on SVB contagion risk and the CPI inflation report. The latter will be the biggest event of the week and is scheduled for release on 14 March, Tuesday. A tame CPI inflation rate could give Fed the option to raise the interest rate by 25 basis points instead of 50 basis points. To me, it's actually quite a close call between 50 and 25 basis points. In fact, the odds of a 50 basis points rate hike surged from 30% on Monday to over 80% following Powell's testimony, but then it fell back below 40% on Friday. It's related to the SVB saga. Why so? Let me explain. So basically, the world is right now watching and analysing to see if the meltdown of SVB is a signal of systemic risk for the financial system as a whole. In layman terms, it means whether the broader banking sector is on the brink of collapsing like 2008 or not. If yes, then we are in trouble. Just imagine if too many panicked customers start withdrawing their deposits from a particular bank, a bank run can happen, and it will trigger more panic, aka a banking sector contagion. Anyway, currently, there are analysts who already came out to say that they believe this SVB's collapse is an isolated case, and they believe that the contagion risk can be contained. Okay, so what has this got to do with the Fed interest rate hike? Well, so the thesis here is that Silicon Valley Bank troubles may lead to a smaller Fed rate hike. To explain in simple terms, SVB's collapse is in a way affected by the Fed's rate hikes. The reason is because Fed's over-tightening of its monetary policy is inducing stress into the banking system. It's sort of moving the economy closer towards recession and a hard landing, which may result to more things in the financial system to break and fall apart, just like SVB. Therefore, the Fed may have to scale back on their rate hikes to prevent contagion and to avoid a banking crisis and a collapse of the financial system. Okay, all in all, in the very near term, watch how this SVB saga turns out. Wall Street will likely take its cue from this case and the banking sector. I mean, you have a major US bank collapse, the biggest bank failure since 2008. That's going to spook the market inevitably. And in my view, the full extent of the effect of this bank collapse could take weeks or even months to pan out, and investors may be very cautious in investing in smaller banks as well as tech startups, which are associated to SVB. Alright, now let's move on to the technical analysis segment. I'm going to spend more time on SPY this week because of the weak market. So anyway, if you had followed my last video, you will know that I cautioned about a potential fakeout in MACD, which happened on 3 occasions, in May, September and December 2022. Each time the market plummeted. And here we go, we had a fakeout in MACD for SPY last week, and it was followed by 2 huge red candles. Well, if you have benefited from this, I hope you can help me tap the like and subscribe buttons if you haven't. Okay, so looking ahead, SPY has entered a danger zone, and that's the area below the super long downtrend line. For info, it's not uncommon for a stock to break free from a downtrend line and then come back to retest it. The retest is important in my opinion. It needs to bounce off it before we can confirm the uptrend. So right now, SPY couldn't bounce off it, and therefore it's bearish in my opinion. To add on to that, it also broke below the 200 moving average, as well as the 38.2% Fibonacci retracement level. That's 3 support levels in total that were broken. And I have talked about these critical levels for at least 2 or 3 videos. So when these support levels break, it's bearish. Okay, in case you're wondering, does this mean all hope is gone? Are we headed for a brand new low? Well, I don't have a crystal ball to predict that, so I would suggest let's take one step at a time. Based on the chart, the next support level is 382, but in my opinion, the more critical one is actually the 61.8 Fibonacci retracement level at 374. When that breaks, I think SPY has a chance to waterfall down to around 250's range, and that's about 20 points downside from 370's range, which is a massive drop in SPY's context. And somehow it's always interesting how a chart can set up so nicely into a big event. And the upcoming big event is none other than the CPI report. This will probably be the catalyst that will determine if SPY will break more support levels below or rebound back above the downtrend line. If you have been following my videos, I hope by now you would know how to interpret my technical analysis. To put it in very layman terms, as long as SPY is below the downtrend line and 390 level, I am leaning towards bearish and will not buy calls or go long. But that being said, because I do not have a crystal ball and nothing is guaranteed in the stock market, so we cannot say that it is for sure that SPY will slide further down. Therefore, let's now look at the upside possibility. As shared earlier, SPY needs to reclaim the 3 key important levels, which is around 388 to 390. We need at least 2 green candles above 390 to have a chance of grinding up in this weak market. To me, CPI and Powell will be key in the next 2 weeks. Good news from them will see SPY go above 390 and start testing 400 again. If we can close above 400 for 2 days or more, the chance of filling that gap at 407 to 408 is high. Lastly, don't forget SVB's collapse could be a potential curveball. That said, every coin has 2 sides. If SVB saga turns out to be just an isolated case and the fear of a financial system meltdown eases, then the broad market may not sell off as much as last week. Next up, let's talk about Apple. And guys, please check out my last video and follow me on Momo app. I almost got all the bear and bull scenarios right for Apple. I will link my last video at the top. Okay, so in that video, I shared that if the market opened strong last Monday, then Apple could march towards 153, where the gap is, and further strength will send it towards 157. Guess what? Apple really filled the gap at 153 and went to 156.3, just slightly short of 157. Then on Monday, I posted on Mumu that Apple's gap up is not good in my opinion. And thereafter, Apple retraced back in the next 4 days to fill that gap. Once again, if you have benefited from this, please help to tap the like and subscribe buttons. Okay, for this week, watch out for this gap at the bottom and the 200 moving average very carefully. The level is around 146 to 147. At this point, it's almost high probability that Apple will touch this area. But the bigger question would be, will this level hold? It is quite critical in my opinion because amongst all stocks, Apple has the biggest weightage in many hedge funds or institutions' portfolios. So if Apple slides below the 200 moving average and stays there, it is bearish for the overall market. So let's say CPI came in bad and Apple falls below that level, the next demand zone for buyers to step in is likely 140 to 143, which is made up by two support levels, and they are the 50 moving average and the 50% Fibonacci retracement level. After which, the last and final line of defense lies at 136, because not only that's the last Fibonacci retracement level, by falling below that, it also means Apple is going back into this downtrend channel. And when that happens, I'm not sure how red will the market be, but yeah, it will be quite red for sure. Anyway, I think it's quite unlikely to happen this week though, unless CPI come in super hot and the whole banking industry goes through a complete meltdown. On the upside, it's quite simple. Apple needs to reclaim 149 level, then we will have a chance to go towards 157. But given the current weak market sentiment, at max we may just chop around 150's range, unless there is good catalyst to move Apple beyond 157. Then that will unlock more upside to around 165. Let's now hop over to Tesla. Last week I shared that when Bollinger Band gets real tight, it is often followed by a huge move. And if Tesla's next direction out of the tight Bollinger Band is on the downside, then 185 will not hold. Best target will be at least sub 170. And there you go, Tesla fell about 12% last week. And indeed, 185 did not hold, and Tesla hit sub 170 as per what I have shared. By the way, sorry I usually don't have this segment, but just a quick one. If you have found value in my videos all this while or benefited from my sharing, I'm not sure if it's too tall of an order for you to sign up for a Weibo account via my referral code. I will put in the description box below. I am just pending one more sign up to complete the 3 referral program, and the promo is ending on 15 March. Do help me out. Otherwise, you may consider buying me a coffee to support my channel and keep me going. Also, don't forget the like and subscribe buttons, okay? It will really help this channel a lot. Anyway, for this week, watch how Tesla tackle this 38.2 Fibonacci retracement level. If the weakness continues, I think Tesla could easily fall towards the 50 moving average at 166, as well as the next Fibonacci retracement level of 159. In fact, in my previous video when Tesla was close to 200, I have shared that I don't mean to scare anyone, but if the market continues to be weak, we could really easily fall to 160s and 150s range, and I think we are not too far off from that right now. In short, this statement is still valid as of this week, and to be frank, if the 50% Fibonacci level does not hold, we have a high probability of filling that big gap at 146 to 154. On the other hand, let's say we get some good news this week, be it from the SVB saga or the CPI number, and Tesla wants to fly, the next immediate hurdle will be 190. When that breaks, Tesla could easily fly back above 200 again, and probably chop around that range between 200 to 215 or 217. Heavy resistance is at 219, where the 200 moving average currently sits. I think sellers may step in at that area until the market sentiment turns a little better. Moving on to Google now. Google is currently sitting at the support level of 90. It actually broke above it, and now it's doing a classic pullback and retest of this support level. To add on, the Bollinger Band is squeezing now, and if you recall, last week I shared that when the B band gets narrowed, it is usually followed by a big move. So that could be some big movement coming up this week. Similar to SPY, I just find it interesting how Google is holding at the support level, setting up so nicely for this week's CPI data for a potential huge move. And oh, to add on, MACD is crossing down already, so another 1 or 2 red candles will confirm the bearish trend, Once 90 breaks, we are looking at 85 to 87 as the next support level, followed by the recent low of 83. I think about 2 videos ago, I shared that at 83 it has to bounce so that we can have a bullish triple bottom formation. If not, we could slide to 70s range, and that will be super good opportunity to load up some shares in my opinion. On the other hand, for the upside, resistance is at 100. The heavier resistance should come in only when it hit the 200 moving average at around 102. For the last few times, whenever Google breaks above 100, it only lasted a few days. It's only the recent one where it went above 105 and hit a high of 108. So what does this mean? It means at this point, it seems like 100 to 105 is a profit-taking zone or supply zone where sellers will step in. And if you are a short-term trader, you may consider taking profits around here. Well, not a financial advice of course. Okay, this week I have not much updates on my option trades, so I will add in Meta technical analysis. Okay, for Meta, it gapped up previously and broke above the resistance level of about 185. Then it retraced below and did a classic retest of this level, which it then got rejected. If the weakness continues, the next support is at 50 moving average at 158. When that happens, it is likely we will fill this huge gap up by hitting around 154. Strong support is at 200 moving average at around 150. As shared previously, I think this huge gap is too glaring to be ignored, and there is a chance for us to hit lower to fill some part if not all of the gap. Okay, but let's say I am wrong and Meta doesn't want to go down, then bulls will want to see Meta reclaim the support level of 185. We need to break above it decisively, then we have a chance to charge towards 200 level. Interestingly, we had a golden cross recently where the 50 moving average moves above the 200 moving average. This is a bullish sign. But that being said, I would like to caution that one should not only use a single indicator to determine a trend. Yes, golden cross is a positive sign on textbook, but it is also good to stay cautious under this weak macro climate. Okay, some end thoughts from me after so many things have happened last week. Following the collapse of SVB, the investing world is currently trying to assess if there is another banking crisis on the horizon, like the one we had in 2008. If bank contagion fears grow, that would be ugly for the economy and the stock market. However, if SVB saga turns out to be an isolated case, the overall market confidence could then be restored. In my opinion, the next 2 to 3 weeks will be key in determining whether the US stock market will have a big flush or not. Because while we watch how this SVB saga pan out, we also have CPI inflation report and the Fed's rate hike coming up. They are all interrelated as per my earlier explanation. Well, the Federal Reserve may try to be more prudent and careful in their next rate hike in view of a potential banking crisis. Let us still remind ourselves that inflation is still very sticky. Yes, inflation has come down, but it's nowhere near the Fed's 2% target. Personally, I think we should not lose track of the big picture. I mean, if SVB's incident proved to be an isolated case, Fed still has their main job to do, and their big picture will revert back to bringing down inflation. This also means to maintain the interest rate at a high level for a long period of time. All in all, at this point, the market is pretty shaky, volatile, weak and uncertain as compared to the first 2 months of the year. We have so many bad news and even greater uncertainties. Small things can lead to big reactions, and that seems to be the case with bank stocks. Therefore, risk-averse investors should probably consider staying on the sidelines to see how this latest saga shakes out. If SVB case turns out to be less than a systemic issue and upcoming CPI shows improvement, then new buying opportunities will arise. So once again, I urge everyone not to lose track of the big picture, as Fed is trying to balance the job of lowering inflation while not causing a financial meltdown. We need to understand that the overall market is still weak and to realize that these high interest rates are here to stay, and the Fed is unlikely to pivot anytime soon. And oh, don't forget, Powell did say some pain may be necessary in the economy when the team attempt to bring inflation down. Just not sure if this latest saga is the pain he is referring to. So what are your thoughts on the latest SVB meltdown? Are you concerned that something bigger is brewing? Would love to hear from you in the comments section below. Meanwhile, do help to tap the like and subscribe buttons please. Thank you.